Hey guys, welcome back to 90 Seconds with Chris. In today's video, we're going to talk about return on investment, ROI, which is often called return on capital, ROC, or return on capital invested, ROCI. This is just simply a ratio that compares the amount of money invested into a company to the amount of profits or returns of the company within a specific time frame. This time frame could be a quarter, which is 4 months, a year, or even 10 years. This ratio helps investors estimate the profitability or lack thereof of a business. Back to my bakery example, where I needed $10,000 for startup costs, but I only had $2,000 to put down. So I had to raise the $8,000 difference by selling stock to 8 investors at $1,000 per share. Say after our first year in business, the bakery pulls in a profit of $20,000. This means the bakery made 100% return on investment, or the ROI equals 100%. ROI is simply calculated by this formula: profits minus initial investment divided by initial investment multiplied by 100. In this case, $20,000 in profits minus $10,000 initial investment divided by $10,000 multiplied by 100. This gives us a value of 100%. This means that each shareholder, including myself, has pretty much doubled their initial investment in the company. Each of my 8 shareholders still own their $1,000 invested in the company. However, they also have claim to the $20,000 profits made by the company. So if we were all to share the profits, they would each get $2,000 each and still own their $1,000 stake in the company. At this point, the bakery can decide if to share the profits or to reinvest the profits back into the business to keep growing the equity. That's it for the video, guys. See you in the next one.